Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So again, you can see how the U.S. dollar has really funded these other asset classes, and this correlation, believe it or not, is still in play. A little closer look at the U.S. dollar index, as you can see. Again, we're still about 5 points away from the 5.5 points away from the low that was made back in March of 2008. But definitely have fallen through some decent support areas that people were looking for the dollar to hold. So now the question is, are we going to go down and test that low? Are we in a major bear market in the U.S. dollar? Are we not only going to test that low, but are we going to see a dollar crisis, which I think is on the minds of a lot of people. And just the fact that the idea of a dollar crisis is on the minds of a lot of people leads to a lot of negative sentiment, whether true or not. Negative sentiment leads to people moving money and selling more and more. And as I started off with, what's very interesting about this market, at least in the dollar we've seen of late, I think more so than the other periods, is it's taken on a momentum quality very much like the NASDAQ, we think, back in 1990s, where on a lot of relative measures, the U.S. dollar is very undervalued here, but it doesn't really matter. Every little increase in the U.S. dollar really is seen now as another opportunity to sell it. So sell the dips, where in the NASDAQ it used to be buy the dips, and it worked and it worked and it worked and it worked no matter what. And it's working here in the U.S. dollar. So part of the problem in trying to even define fundamentals and define some technical levels in this type of market, as I started off with, is in a momentum market, none of it matters. You just have to keep playing the game until everybody's in and everybody's so positioned at an extreme level that there's only one way left to go, and that's up. I don't know if we've reached that yet. We probably haven't. Even technically, if you look on a weekly basis, there's probably more left in this decline, you can say, with a degree, some degree of probability on a technical level, and justify it. And even from a positioning standpoint, we haven't seen maximum historical positioning short the dollar in here again, which would suggest there's some more left on the downside. So there's a lot of good reasons that the dollar could go a lot lower, and we're going to talk about some of those reasons now. This is a framework that I've been using, and we've been using, I should say, John Ross and I here at Black Swan for several years. This came from Stephen Jen. He was a currency analyst for Morgan Stanley, really a brilliant guy, and used to write on Morgan Stanley's website. He's since left Morgan Stanley to go into the hedge fund world. But this is a framework that I think even if you take nothing away from today, I think if you take this away, I think it really just help in terms of getting your arms around these global macro themes and simplifying them into a yes-no decision and what's going on here. This is what he referred to as the dollar smile. And on the left side, if you look at the left corner of the smile where it goes up, that's called the risk bid. And we've seen that. Stephen Jen created this, I think, in 2005, well before we saw a massive risk bid in the dollar. But we've had this in the past. I mean, it's not unusual to see the dollar get a risk bid of people hiding because it's the world reserve currency and we have the deepest capital markets. When people hide, they got to hide into the treasuries. When you have massive pools of capital to hide, you have to buy the treasuries, no matter how bad it is in the U.S., because if you're afraid what's going on globally, that is the only place, and the dollar is going to naturally do higher. And I think that was a mistake a lot of people made during the credit crunch. They said, well, most all these problems were coming from the U.S. The U.S. created the problems. The headline news in the U.S. was ugly, ugly, ugly. The dollar has to fall and gold has to go up. Well, they were right on gold. Gold did well and held up pretty well, but the reality was dollar didn't have to fall because it's a major risk bid. Major money flow had to come back into the U.S. no matter what, and that's what we saw early on. The other part of the smile, if you go up to the upper right-hand side, we'll cover that first, is the growth surprise. And that says the dollar rallies on growth. And when you come out of a recession, usually the world reserve currency at least from the U.S. economy standpoint, tends to do better during recessions because historically, and this may be different in this cycle. Historically, the U.S. has been a lot more flexible than its competitors, its major industrialized competitors during recession. We've usually come out first, the Fed has raised first and faster, and the U.S. has grown faster, come out of a recession. So in that growth surprise, especially if it's a surprise and the U.S. really comes out, the dollar tends to get a power move on money flowing into the U.S. on the idea that the yield differential will improve in the U.S. dollar, and the growth change, people wanted to put long-term capital to work. So those are the two positive sides for the dollar. Obviously, the risk bid side of the dollar is a short-term, more of a short-term game. The dollar is going up not on anything to do with really good reasons or fundamentally in the U.S. economy, but because it plays that safe haven role in the U.S., which now, of course, is being challenged. The bottom of the smile there, there's really a couple scenarios where it really means the dollar goes down. It's the muddle through scenario or the implicit weak dollar policy scenario, which I'll explain in a second. You also have to layer in there probably a second scenario on that bottom there of the dollar falling is the idea of a dollar crisis, and we'll talk of that. And that's the pull the cover over the eyes type of dollar crisis, which is not good for anybody in the world, especially U.S. investors, because any dollar crisis we think will be met with not only a movement out of the dollar, but one of these triple whammy type movements of money coming out of treasuries, which we think would trigger any real dollar crisis, and also money coming out of stocks at the same time. So looking at the risk bid scenario and the potential from here going forward, a risk bid scenario, we actually believe for many months that in the midst of this green shoots, we get a major risk bid. And that was our story, and that's why we really have been behind on the curve, unfortunately for our clients, in this move down in the dollar since the green shoots area started. We didn't think that, again, China could keep the music playing, but China really did keep the music playing in a very, very big way. And we underestimated the amount of money that they throw into this, and we also just underestimated that they'd be able to hit the numbers that they projected in the midst of this. But a risk bid scenario really is this idea that, hey, everybody now believes that the market's going to grow. We're in that yellow territory. But all of a sudden, something happens. There's a major crisis in the world. Maybe China has social unrest. Maybe we wake up and China says, okay, we're going to stop lending. We're too overexposed, and we have a stock market crash in China that ripples through into the emerging markets. So this idea of another risk bid scenario for the U.S. dollar, I think, is still in play, especially if you're a person that looks at these markets as we do and says, at least from a valuation standpoint, they still look ahead of themselves because of still the lack of global demand in the world from the major consumer areas, the U.S. And Euro. But the reality is, it doesn't matter that that's some of the fundamentals. The market now believes that growth is here and numbers will continue to get better, and they do have the numbers to support it. So stock markets discount the future, and if things are going to get better, stock markets can keep climbing, and especially if a lot of people like me are so worried about the stock market, the market tends to climb that wall of worry. When everybody capitulates to the trend is when we have to worry, of course, but I'm not sure everybody has capitulated to the trend yet of this move in the U.S. stock market, or risk assets continuing to move higher. So therefore, I think this risk bid scenario, which to us was very much in play, really has taken a bit of a back seat in here. But if we do see it, we will see the follow-through, or at least the results of this would see. You really want to watch the emerging markets, because we think China really is ultimately the driver of all this good news that's going on in the world. No surprise there. But if we see some type of capitulation out of the emerging markets, and again, that's open to question even what China stock market does, because we saw China's stock market come off pretty badly over the last few months, but yet it didn't budge in terms of the emerging markets in general. The optimism stayed in track, and China's stock market was looked at just as an internal problem, but we'll see going forward.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.